Well, Oaktree has historically had its greatest successes at times when the economy is not doing so well.
Sure.
And it brings to mind your latest memo, on the other hand.
Yes.
And I want to quote directly from it, Howard, because in it you say, and I want to point out that you've dedicated quite a bit of time to macro thinking and Fed policy, if you will, in your last two memos. In this one you say, should we be happy to see the Fed trying to prolong the economic expansion in the bull market when they're already the longest in history? Should it try to produce perpetual prosperity and permanently ward off a correction? Are there risks in its trying to do so? It all depends on which hand is doing the weighing. That's a somewhat cryptic, to me, way of questioning,
well,
at the very least, what the Fed did at its most recent meeting. Howard.
I'm never convinced enough that I'm right to be assertive. I mostly raise questions. But, it is unusual. I mean, usually what happens, we stimulate the economy when it's doing poorly, and we want to wake it up from the doldrums. We generally don't stimulate the economy when after 10 good years. We usually accept that there will be an ebb and flow to the cycle, and that that there might be a justified recession. We have the lowest unemployment rate in 50 years, and you usually don't stimulate at that time. So the point is that the Fed can stimulate. Should it do so? Is it the Fed's job properly to?
I get the feeling.
No,
you don't think it should.
I don't think it should. I don't think that. I don't think the Fed's job is to make sure there's never a recession. What the Fed chair tends to say, and Jay Powell said it last month, and I have a quote in there from September '07, where they said we're going to do what it takes to keep the expansion going. Is it the Fed's job to keep the expansion going forever? And I don't think so. If I ran the Fed, and I'm not applying for the job, what I would do is when the economy is roaring, I would try to cool it off so there's not too much inflation. When it's really weak and not creating jobs, I would encourage it and stimulate it. But in between, I'd leave it alone.
If the Fed keeps cutting rates, and that's what the market says it's going to do, Howard, what does that mean for investors? When, as you point out, the 10 years at 175,
yeah.
High-grade bonds are paying 3%, high yield is something in the order of 6%?
Yeah. It means that savers and lenders and people with money are going to have trouble getting good returns. All the returns emanate from the base rate, which is basically what the Fed sets. And the lower it is, the lower the prospective return on everything is. Now, the process of lowering the rates, it causes assets to inflate. So there will be more wealth piled up by the people who have assets, and it'll be harder for people who just have a little bit of savings to get a return.